Hey everyone, and welcome back to the Noob Selling Options channel. I'm absolutely thrilled to have you here. In today's explainer, we're going to completely deconstruct what turned out to be a wildly successful trading week. We're talking about a portfolio engine literally firing on all cylinders, balancing heavyweight tech with high implied volatility growth plays, and most importantly, staying strictly disciplined. If you've ever wondered how to actually scale your income using the wheel strategy, well, you are in exactly the right place.
Okay, I just want to focus on this number for a second. $3,047, hitting over $3,000 in realized cash flow in just a single weekly expiration cycle. That is a massive milestone. It totally proves how systematically applying cash-secured puts and covered calls can generate serious, tangible options income. But look, we're not just here to stare at a big number today. We're going to reverse engineer exactly how this specific option strategy pulled in more than $3,000 in literally a matter of days. And hey, if you're totally new to the wheel strategy, where we basically sell options to collect premium and acquire shares at a massive discount, don't sweat it. We're going to make the whole shebang crystal clear.
All right, let's literally dive right into the receipts here. We're looking at the Week 5 realized tally, the raw spreadsheet data. Across 20 total trades balancing both calls and puts on big tickers like Broadcom, Microsoft, Tesla, and ServiceNow, the grand total tallies up to exactly $3,047. And look, sharing this isn't about bragging, right? It's all about transparency and building real trust within our community. You got individual premium lines here, some smaller, steady ones like SoFi, and absolute monsters like Broadcom. Every single one played a crucial part in this week's win. To make sure you get the absolute most out of this explainer, we're breaking the whole thing down into 3 parts. 1, the capital recycling engine. 2, cashing in on earnings. And 3, portfolio power plays. So, kicking things off with Section 1, the capital recycling engine, focusing on maximum efficiency. You know, if there's literally one secret to scaling your options income without just endlessly dumping more of your own cash into your brokerage account, it's capital efficiency. It's basically the art of doing way more with the exact same budget. Instead of letting your collateral sit there doing nothing, you actively manage your positions to free it up and redeploy it. Here's exactly how I played the timeline this week. On Monday, I opened a cash-secured put on Broadcom. Once rapid theta decay, which is just the option losing its value as time ticks by, made that position heavily profitable, I didn't sit around waiting for expiration. No way. I closed it early to lock in the win. That instantly freed up my capital, which I immediately rolled right into a Microsoft put on Wednesday. And guess what? When that Microsoft put got heavily profitable too, I closed it out, freed the capital up yet again, and entered a Friday put on Tesla. It is literally textbook execution.
So here is the absolute key takeaway. We used one single budget for all of that. I had $76,250 in cash collateral. Instead of keeping it trapped through expiration on Microsoft and Broadcom, closing early liberated those funds. By recycling that same capital, we banked a massive $584 from the Broadcom trade and another $248 from Microsoft. That's $832 totally locked into the realized profit column before Friday even started. And honestly, it lets us sleep so much more soundly because it completely eliminates the downside gap risk on those 2 legs.
Moving right along to Section 2, cashing in on earnings, specifically looking at Tesla and ServiceNow. Okay, so what do you actually do with that freshly liberated capital from Wednesday? You target the highest yielding setups on the board. This week, both Tesla and ServiceNow were reporting their Q2 earnings after the closing bell on Wednesday. Now, earnings mean peak implied volatility, and as option sellers, volatility is literally what pays us. Just look at the sheer amount of premium up for grabs just for providing a buffer. By selling the $350 strike cash-secured put on Tesla, we scooped up $324 in premium. For ServiceNow, selling the $90 put brought in $221. That is a combined $545 in rich, heavily discounted premium from just 2 trades. You're getting paid maximum yield on your newly released cash reserves right before the earnings print even drops. Now, I completely get that holding options through earnings gives a lot of traders major anxiety, but we actually frame these strictly as win-win scenarios. Think about it. In scenario A, the stock stays above our strike price, the post-earnings implied volatility crushes, basically deflating the option's price like a balloon, and we keep 100% of that premium as pure, sweet income. But even in scenario B, right, if the stock dips and we get assigned, we are simply buying great tech stocks like a premier, highly volatile EV maker or an enterprise AI software leader at a massive, massive discount. And then we just instantly launch the covered call wheel. Let's actually run the math on those entry points. Because we collected that incredibly rich earnings premium, if we do get assigned,
our effective cost basis drops like a rock. For Tesla, collecting $3.24 per share in premium drops our true entry price from the $350 strike all the way down to $346.76. And for ServiceNow, our cost basis drops below the $90 strike to a fantastic $87.79 per share. So these earnings setups give us significantly better premium and at a much discounted price for entry into quality names. Seriously, it's a fantastic deal either way you slice it.
And that brings us to our final part, Section 3, Portfolio Power Plays and Wheel Strategy Highlights.
So we've talked about the capital recycling and those juicy earnings setups, but remember, there were 20 trades in total that pushed us over that $3,000 finish line this week. The rest of this income came from strictly disciplined execution of the wheel strategy across different sectors. Out of the $3,047 total, you get this really beautifully balanced distribution. $1,884 of it came from 12 different cash-secured puts. Another $1,096 came from 7 covered calls, which perfectly shows how we're monetizing the upside of our assigned shares. Oh, and we even snagged a quick $67 intraday swing profit on a tactical long put for Tesla, just showing a little adaptive agility when the market gave us a short-term directional move. Let's rapid-fire through how this builds out across the rest of the portfolio. We harvested a massive $343 covered call premium on SpaceX, totally capitalizing on the high volatility in the space tech sector right now. Then, we snagged $165 on a Palantir covered call, sitting right at upper resistance levels. We also ran multiple leg plays on Iris Energy and DRAM for a combined $481. And finally, we utilized a stacking strategy on SoFi, selling multiple contracts at a lower, safer strike price to generate a really reliable $99 in baseline income. Literally every single trade contributed to the engine.
So I want to leave you with a quick question to think about. How are you going to recycle your capital next week? Are you just letting your collateral sit totally idle through expiration, or are you going to actively manage it to capture the very next volatility spike? I really hope this explainer showed you exactly how powerful a disciplined, capital-efficient option strategy can be. Now, if you found this breakdown valuable and you want to keep learning how to build your own options income engine, please hit that like button and definitely subscribe to the Noob Selling Options channel. We've got a lot more deep dives coming your way. Until next time, trade smart and stay disciplined.